All right. Good morning, everyone. Thank you for joining on this sunny, but not so warm April morning. For those of you who don't know me, my name is Jacqueline Ozdemir, financial advisor at Ferguson Financial Planning here at Asante, and I will be taking you through today's webinar on socially responsible investing. What is it and how does it fit into your portfolio? The webinar is expected to last about 45 to 60 minutes, just depending on the number of questions that I sort of receive throughout. And this is set up as a true webinar, meaning that you can see and hear me, but I cannot hear or see you. Just because I can't see or hear you doesn't mean that this cannot be interactive. So you should have the option at either the top or the bottom of your screen for a chat or Q&A. Feel free to flip me a note through that. And of course, if I don't get to your question throughout the presentation, I will try my best, or someone from the team will get back to you within a few days. So, as most of you attending today know, that our team here at Asante offers a wide range of financial planning services. So this includes, from will and estate planning, tax planning, insurance planning, and of course, investment advice and strategies. Looking at the investment side of things, one thing that is coming up more and more is this whole idea of socially responsible investing. I think in the past year, with everything that's been going on, a lot of folks have really been looking at their portfolios as well as the companies that they might be individually investing in and really asking the question of, is this a good company? And do the values in what this company does it really align with my personal values as an investor? The idea of screening investments to determine whether they're socially responsible or not isn't necessarily new to the world of investing, but it is something that has, moved a little bit more from the margins to the mainstream in the past couple of years. Okay. So, you would have received an invitation for this webinar today and probably saw what we were going to talk about, but just to sort of reiterate, some of the main themes we're going to hit on today is, what is socially responsible investing? It is a bit of a tongue twister to say socially responsible investing. So throughout the presentation today, I might refer to this as SRI from time to time, okay? For anyone who knows a little bit about socially responsible investing already, you probably know that it's very hard to talk about this topic without at least bringing up the idea of environmental, social, and governance factors, okay? And as we're going to learn sort of as we go throughout the presentation today, is that this is a tool that we can use to help us assess whether a company or an investment really is socially responsible. So diving into those topics a little bit more, we're going to look at, of course, what they are. Specifically, how do we measure SRI? So how do we figure out whether a company or an investment really is socially responsible? We're going to use the factors of environment, social, and governance to help us assess whether a company is socially responsible. And then we're going to take a look at to see, why are these types of investments and why are these terms becoming a lot more popular? We're going to look at who is really, driving these changes or promoting these types of investments and who's currently investing in them. And then once we've learned a little bit more about, what a socially responsible investment is, we're going to figure out how you as an individual investor can actually go about buying, these types of investments. And of course, it's important to also mention, if I'm going to buy these investments, how can you actually go about incorporating them into an existing portfolio? Or if you're building a portfolio out, how can you go about including them? Now, throughout this presentation, I'm not necessarily going to recommend that you should go out and buy these types of investments, okay? I'm going to try to remain relatively neutral as to whether, on my opinion as to whether or not they should be included. My goal here today is really to educate you on these topics so that you can make the decision as an investor whether or not that's something you want to start incorporating into your portfolio. And then, of course, myself and the team at Asante is here to help you do that and provide guidance on maybe some of, our top, socially responsible investments that we like recommending, okay? So diving right into things, what is SRI? What is socially responsible investing? It is a bit of an umbrella or an aspirational term. So, very generally speaking, it refers to sort of this investment strategy that not only looks at companies for their financial returns, because obviously, we all want to make money with our investments, but is this company doing any sort of social or environmental good? And when I say environmental, I'm not just talking about companies that are good for the environment, like investing in a wind turbine company. And, that is an example of a socially responsible investment. But socially responsible really extends beyond just climate change and the environment. And it can include things like, companies that are promoting human rights or social justice or gender equality, or favorable labor practices, okay? So those would all sort of be examples of companies that are promoting social responsibility. Giving some examples, if I was building out a socially responsible portfolio as an investor, I might say I'm going to include certain types of companies and I'm going to exclude other types of companies. So, for example, I might state that I only want to include companies that are having some sort of social positive impact. And yes, this could be something like incorporating a solar energy company into my portfolio. And I might say I'm going to exclude certain investments that might be somewhat controversial. So a lot of times socially responsible investing is kind of a matter of weeding out, companies that are deemed to be bad or including companies that are good. A lot of times if we're looking at, funds and ETFs particularly, and I will talk about this more later, but a lot of times sort of those four big sectors that are often excluded from a socially responsible investment or portfolio is, companies engaged in firearm production, tobacco production, companies that promote gambling, and companies that use fossil fuels, okay? So those are kind of the big four when we look at, looking at today, those are kind of companies that might be considered not socially responsible. So, for example, if we're going about building a portfolio, we might say, okay, if I think that tobacco and fossil fuels are bad, I am going to build a portfolio, but I'm going to specifically exclude those types of companies regardless of how they're performing financially, okay? Instead of including those companies in my portfolio, I might then start to actively seek other types of investments. An example could be an organic food producer who's growing food organically and providing it to grocery stores at a good cost or a low cost, okay? That could be an example of a socially responsible portfolio. Another example might be if you're against war, you might purposely, try to exclude companies that are engaged in either missile or firearms productions, okay? And instead, you might try to invest in companies that are involved maybe in, providing clean water to underdeveloped nations, okay? Again, very high level, those two examples I gave are, sort of examples of socially responsible portfolios. Now, in those examples, it was very obvious or easy to conclude that something like a low-cost, healthy food provider or a company that's trying to provide clean water to the world, yeah, those are pretty obviously, socially responsible investments, okay? We can kind of understand, without doing a lot of research that, yeah, those companies are probably good for the environment and for mankind. On the flip side, we could also say that, companies that engage in firearm production or use a lot of fossil fuels, those are probably bad investments. And maybe I don't want to include those in my portfolio, okay? Again, looking at it strictly from the socially responsible lens. But not all companies and not all investments are going to be so obvious. So, if again, I'm looking at building a portfolio, for example, if I'm looking at different companies, I might be looking at a company that is a shoe and clothing manufacturer, and they get a lot of their products made in China because the cost of labor is cheaper. Is that a socially responsible investment? Or what about a car manufacturer that is making cars that are gas powered, not electric? Is that a socially responsible investment? So it becomes a little bit harder when we start to look at certain sectors to conclude, I'm trying to build a socially responsible portfolio. I don't know what to include. I don't really know what factors I should be looking at. So today we're going to talk a little bit about, how can I measure some of these less obvious companies to conclude whether or not they are socially responsible. So this brings me to my next topic of, measuring SRI. So I'm going to throw up on the screen here a couple different, things, different ways that we can measure SRI, and then I'm going to go through I'm going to go through each of them one at a time. So the first way, to measure whether an investment is socially responsible or not is kind of this idea of screening. Now, in the examples that I used on the previous slide, I talked about building a socially responsible portfolio and that I was going to purposely exclude companies that might be considered somewhat controversial. Again, gambling or, companies that make firearms. Okay, so I've gone ahead and I've just excluded those companies. Or I might say, I'm going to build a portfolio, but I'm only going to include companies that I view as positive. And, climate change is really important to me. And human rights. So I'm only going to invest in companies that are producing clean energy or companies that have really strong hiring practices, equal pay across genders and backgrounds. So, those are the only types of companies I'm going to invest in. That would be an example of screening. So I'm putting this sort of wall up to say yes or no, and I'm not really looking at the company any further than that. Now, there's obviously some problems with this. Okay, so, this idea of socially responsible investing isn't necessarily a one-size-fits-all approach. What's good to me might not be good to you, or what I consider to be good might not be what you consider to be good, and vice versa. Okay, and it's possible that by using this high level of screening and just sort of saying a yes or no, whether or not to include it in my portfolio, I might actually be missing out on really great companies and really great opportunities because they didn't pass my initial screen, so I've just decided to exclude them. I like to use examples. So going back to my previous example about a car manufacturer, I said, is a car manufacturer that's making fuel-powered cars, is that a socially responsible investment? Because I think we all know that carbon emissions that cars produce really aren't good for the environment. So should I be investing in this type of company? Well, once if I told you that this particular car manufacturer, all their factories are 100% solar powered. Okay, so they're making all these cars with renewable energy. And what if I told you that this company is set up in countries across the world and has provided thousands of jobs to people in countries where it's traditionally been really hard to find employment? When I start to look at it that way, this company all of a sudden, maybe it does pass my socially responsible investing screen. And maybe this is a company I should be including in my portfolio. Now, I would have not originally, concluded that if I had not done a little bit more research. So this brings me to my next point, which is sometimes we have to drill down on these companies a little bit more to really determine if an investment is in fact socially responsible. And the way we do that is by looking at environmental, social, and governance factors. Okay, so again, this is a bit of a tongue twister. I'm going to refer to it as ESG a lot in this presentation. And I'm going to go through what each of these things mean. Okay, so looking at environmental factors. Environmental factors are criteria are probably the easiest to understand because we're the most familiar with them. So generally speaking, environmental, a company that has strong environmental factors is one that could be producing renewable energy like a wind turbine company, but also it can extend to my idea of this car manufacturer that has good environmental processes in place. So an example of a company that has strong environmental criteria is one that is actively trying to reduce its emissions, reduce its carbon footprint. A company that maybe has weaker environmental factors is one that has a lot of waste and has a lot of pollution. So again, if I'm trying to decide if I want to invest in Toyota or Honda in my portfolio, if both of them have strong financial returns, but one of them has this sort of stronger environmental criteria that it's using and it's trying to reduce its carbon footprint, I might be more inclined to invest in that company, okay, of the two if I'm comparing them. So the next thing to look at is social criteria. Now, social kind of refers to, the people side of things. So how well does a company treat its employees? A company that has a really strong culture and good hiring practices is going to have a better social score than a company that has really high employee turnover and unsafe work conditions, for example. Or if I'm looking at a company and I find out that they engage in child labor or they're underpaying their employees, that's not going to sit well if I'm looking at this company and trying to assess whether it has strong social factors. This can also relay through to things like suppliers or how a company treats the community. Again, how a company treats its stakeholders, like its suppliers, like its employees, is really going to tell me whether or not this company is socially good. Finally, governance. So this one's a little bit more tricky to sort of understand and to maybe do research on, but governance refers a lot to, what is the strength of the board of directors and how are executives compensated? So for example, a company that has a board of directors and the board of directors maybe all come from very diverse backgrounds in terms of education and experiences, that's a strong board of directors, okay? So that's going to help with the governance factors. Executive compensation that's tied to performance is much better than executive compensation that's just sort of arbitrary, and regardless of what happens in the world, executives are still getting big paychecks each year, okay? So those are examples of environmental, social, and governance factors, and we can actually use these to help assess whether a company is socially responsible. So One way we can measure socially responsible investments is through this idea of ESG integration. Okay, so if you're trying to build a socially responsible portfolio, again, we might go through this screening technique and we might say, okay, we're going to exclude certain companies. So we've taken our portfolio or whatever we're holding and we've carved out some of these bad companies. That's not to say that what's left over is all these companies are super, ethical, strong companies. We would need to start looking at them through an ESG lens as well. So start to really evaluate their environmental, social governance. Just because they don't fit into this pocket of these negative companies that I've decided to exclude doesn't mean that they're necessarily great either, right? So we'd want to go through this exercise of looking at what are the environmental factors, what are the social factors, what are the governance factors. A really good example is going back to my first slide when I said, a company that is producing organic food and it's delivering it to grocery stores at a really good price. This sounds like a really socially responsible investment. But if I looked at it through an ESG lens and I found out that, this company actually has a really high carbon footprint, so that's not really good from an environmental standpoint. It doesn't really pay its employees well. In fact, I think it's underpaying its employees or it's paying them below minimum wage. That's not going to sit so well from a social standpoint. And then you find out that the CEO of the company is still taking a really big compensation despite underpaying its employees. Okay, that's not going to sit well from a governance standpoint. So therefore, this company that I thought was super social responsible actually isn't, because I've looked at it through a different lens and I've done a little bit more research. Okay. Also keep in mind that if you are looking at specific companies to invest in, the E, the S, and the G is not necessarily going to be applicable to all companies. So it might not be fair to penalize a company for not being really strong on the environmental standpoint. For example, looking at an online service provider. I don't know if an online service provider really has much of an environmental impact one way or another. You might want to look at that company more, look at their social and their governance, not as much the environmental side of things. Okay, so just keep that in mind. If you are, someone who likes to look at individual stocks, keep this in mind that these three pillars might not necessarily apply to every single company. Okay. Now, what I just talked about, that was a lot. So no, if you're trying to build out your own, stock portfolio, for example, and you're going through the screening practice, and then you're looking at the environmental, social governance factors, that's a lot, right? That's a lot of research to do. So there is tools available that can kind of help us both as advisors and you as an investor to figure out, are these companies socially responsible? So the first one I want to bring up is that, there is some rating scales available. One example of this is the Morgan Stanley Capital International ESG Ratings Index. So you can actually go to their website, MSCI, and there's a search function where you can actually search companies like stocks to find out how they rank on MSCI's rating scale. So you could type in like Nike or Amazon and find out how they rank. The ranking scale goes from, I think, AAA to CCC. Obviously, a AAA is a much stronger company than something like a CCC, for example. Okay, so that's one way that you could kind of figure out, if I'm looking at one particular company, how does it rank? Some of the things that MSCI has used to determine how strong a company's environmental, social, and governance factors are things like they might look at, what is the reporting structure between a company's CEO and their head of sustainability? So if they're direct reports, that's going to score really good on the governance standpoint. If they're 10 layers removed, it's not going to score so well. Another thing they might look at, again, is the board of directors. So is the board of directors, or the people that are coming to the table, do they all come from very diverse backgrounds? Again, different experiences, different education, because that's going to help a company score better on a governance standpoint. As well, like, a lot of the clients we work with, we do invest more in ETF or fund portfolios. So in a lot of these cases, you can actually buy an ETF that's going to, let's say, mimic the S&P 500 index, but with the exclusion of maybe firearms and tobacco companies. Okay, so you can actually sort of buy that portfolio of stocks through an ETF while excluding certain types of companies. So ETFs like that do exist. You can also buy, a mutual fund or a fund that, again, would have an SRI screen on it and might also be doing some ESG integration, so that you can feel a little bit more confident knowing that some of this research in terms of the screening and looking at companies from an ESG standpoint has already been taken care of for you by the fund managers. And again, a lot of times the fund managers will, look at companies from an ESG lens and really rank it from, okay, what are the financial returns versus, how ESG friendly is this? And they'll weight the assets in the portfolio accordingly. Okay. Now, through all this, so whether we're an individual investor or we're a fund manager, we can all fall victim to this idea of greenwashing, okay? Because a lot of the information that is provided about a company's environmental, social, and governance factors is self-reported by a company. So we're relying on the information that they're providing for our analysis. So greenwashing isn't really anything that's new, and it can apply to either you as an investor or you as a consumer. So greenwashing is really this idea of misleading information or exaggerated claims on the environmental friendliness of practices or products. So a really good example I came across sort of as I was preparing for this webinar is, imagine you're trying to build a portfolio. You're building an individual stock portfolio, and you've decided that I'm going to invest in consumer goods. So I'm going to invest in, a cookie company, for example. I'm looking at this cookie company, and they have really good financial returns. And I just found out, I saw a press release that said, this cookie company, their packages are now made from 50% more recycled content. So that sounds really awesome, right? It sounds, okay, this company is really prioritizing their waste, and they're making their packages with all this environmental product, this recyclable product. But then maybe you do a little bit more research and you find out, well, last year their boxes were made of 2% recycled content. Well, a 50% increase only brings that to 3%. That is totally not materially significant. So they've sort of promoted that, look how environmental we are, but when you do the research, you're like, well, 2 to 3% environment or recyclable content isn't really a lot. Another example, and I'm sure we've all fallen victim to this, is, you go to Shoppers Drug Mart to buy a bottle of shampoo, and you're instantly drawn to this sort of nice green bottle that has a little leaf on it, and it says made from 50% sustainable product. Oh, wow, that sounds really great. I don't really know what sustainable product is, but I think that's a good thing. And it has this leaf, so it must be good for the environment. I'm going to buy it, right? Like, I think we've all done that. That would be an example of greenwashing. So, ways to sort of avoid being greenwashed is to, if you're as a consumer, read the label, find out, are the products that they're listing actually sustainable? But as an investor, it would be doing a little bit more due diligence. So really going through the financials or reading through the statements to say, okay, like, what are the activities that these companies are actually engaging in, and how, materially significant is it? Like, if a company says that they're, donating a bunch of money to this human rights cause, if it's a really, really small amount of money compared to the rest of their portfolio, is it materially significant, or have you been greenwashed? I think over time, what we're going to see is we're going to see more and more regulatory bodies come out and start to audit the environmental, social, and governance factors that a company is reporting, and just sort of holding those companies a little more accountable and having more standardized measurements take place. Okay, so I think we'll continue to see that more and more over time. I'm going to talk a little bit about the pros and cons of socially responsible investing before we start talking more about its popularity. But, in years past, I think that socially responsible investments have kind of gotten this reputation for requiring a trade-off on the investor's part. So it's like, you can either choose a socially responsible investment, or you can choose to have strong financial returns. And you've probably thought about this by now, but when you limit your potential investment options or your investment universe, because you're already going to exclude certain sectors, and you potentially start paying more to invest in companies that do practice social and ethical responsibility, are you giving up on your investment return? So we talked earlier about, when you place these high-level screens on companies to say, okay, I'm going to exclude certain industries from my portfolio, you may be leaving really great investments on the table because maybe they didn't score the highest environmental, social, or governance scores. Okay, they didn't do well in those categories. A good example as well could be something like nuclear energy. So nuclear energy is something, and socially responsible investing in general is something that's very subjective. So again, something that I consider socially responsible might not be what you consider socially responsible. And I'm going to go to this example of nuclear energy to say that some people might look at that type of investment and say, no, nuclear energy is bad. There's been some very terrible accidents in the past. I do not want to be any part of this. Other people might look at it and say, I think nuclear energy is a really great possible substitute for fossil fuels. I want to invest in it. So, if you've excluded this type of investment from your portfolio, you could be missing out on potential returns. You know, that's why when we start placing the screens, we're thinking more about financial returns, but we're also considering, oh, am I missing out on future opportunities because I deem something to be negative? On the flip side of this, you know, investors generally, or some folks do think that ESG can help with returns and specifically risk mitigation. So for example, a company that is only about chasing short-term profits, right? They just want to make money for their shareholders. That's all they want to do, and they will do anything to make those profits. A company like that isn't going to spend as much time potentially building the relationship with key stakeholders like the community, like their employees, like their suppliers. And at the same time, if we're all about short-term profits, the employees of these companies may be more likely to cut corners or to sort of engage in more illegal activity, which is going to bring this company more likely to have something like a lawsuit, which is obviously not going to do well for the stock price. By considering ESG factors and the risk mitigation in place, you know, companies may be able to we might be able to avoid companies with bad practices. I think good examples of this is BP's 2010 oil spill or Volkswagen's emissions scandal that happened a few years ago. Both of this rocked the company's stock prices. So while I'm not here to say that, you know, you should prioritize ESG and I think these investments are due to outperform in the future, it does make sense that a company that has strong financial fundamentals, but is also giving consideration to their environmental, their social, and their governance factors could do well in the long term, okay? Now, you know, we're starting to see more pros with these types of investments, I think, and these types of investments are becoming more popular. There's really no doubt that the events of 2020 have contributed to the sudden rise and the sudden interest in ESG investing, or sort of looking at companies through this ESG lens. You know, COVID-19 really intensified the scrutiny of a company's ESG performance. As well, the effects of systemic racism, inequality in access to healthcare, the legal social justice system, and education have really put the ideas of doing good towards both the planet and towards its people in the front and center. Just to throw up some numbers, last year in Canada, there was $3.2 billion that were invested into environmental, social governance type investments or funds, okay? This now brings about the total amount in Canada to $22 billion in assets under management into these types of funds. Morgan Stanley's done a couple of research papers on this, and they have found that 86% of millennials said they are very interested in investing in sustainable investments that aim to generate both a market return and have some sort of social positive impact. And with millennials due to inherit trillions of dollars, you know, from their baby boomer parents in the coming years, this is probably not a trend that's going to go away, right? So if we have all this money coming to millennials and they want to invest in a certain type of, you know, sector or industry, we're going to see these types of investments rise more in popularity. You know, as well with female investors. So in the same study Morgan Stanley did, they found that 84% of women versus 67% of men were interested in sustainable investing. Again, I think as more female investors are taking charge of the family finances, we're going to see more of a push to these types of socially responsible or environment, you know, companies that pass these ESG tests. Okay, and simply put, there is just simply more ESG options available. So, sort of over the last 6 years in North America, the number of funds or ETFs that do sort of these ESG screens have risen from about 139 to 400 different options. So there's more options available for investors. So there's something that can probably pique the interest of any investor, or the values of a particular fund or investment are aligned with different investors, okay? Finally, another reason that this is you know, becoming more popular is because of this idea that ESG investing can help with potential risk mitigation. So companies, for example, that already have very strong hiring practices in place, you know, equal pay in place for their employees, or companies that are already making an effort to reduce their carbon emissions, could be less impacted by social reforms to say, you know, people need, like women in the workforce need to make the same amount of money as men, or we're going to raise carbon taxes. Okay, those companies might be less impacted by those types of movements because they've already started to incorporate these measures into their day-to-day practices, and so their risk measures are stronger. Oh, sorry about that. Okay, so as an investor, you might be thinking, okay, you know, I've listened to the webinar so far. I think I have a stronger idea about what socially responsible investing is. I understand how to measure it a little bit more. You know, how do I get access to these types of investments? So there's a number of different ways that you can do this. The first is obviously you can simply buy stocks or shares in a company that you like. So you can do the research and say, okay, there's a particular company I feel really strongly about. I really like what they're doing. I'm going to buy stocks in that company. You can also buy mutual funds and ETFs. So with a mutual fund or an ETF, it's essentially a portfolio of stocks. And these different mutual funds or ETFs will have a particular mandate. So you might find a mutual fund that predominantly invests in clean energy companies or renewable energy, okay? Or you could find an ETF, and I used this example before, that's trying to mimic a particular benchmark, maybe a global index or one more in North America, but it's weeding out certain sectors of industries, okay? So instead of building that portfolio on your own, you can rely on, you know, a fund or an ETF to help you get a socially responsible investment. You know, there's different, once you actually buy the investment, you have to hold it somewhere. So you can hold these types of investments in an RSP or a TFSA. And for those of you who attended our RSP TFSA webinar a few weeks ago, you would know that these are really these are investment accounts. You put money into them and you can invest in things like stocks, mutual funds, and ETFs. You can also buy socially responsible investments through a stock, a mutual fund, or an ETF. You can hold it in your child's education account, or you can hold it in a non-registered account, okay? If, you know, now you're at the point where, okay, I'm going to buy this, I'm going to hold it in one of these types of accounts, what things should I consider when I'm looking at particular funds, ETFs, or stocks? First and foremost, I would really consider the time horizon. So for example, if you are investing in some new up and coming renewable energy companies, whether you're holding these as individual stocks or you've invested in a fund that's holding these types of stocks, consider your time horizon. Something that's new and speculative might see a lot of volatility in the short run. So if you're thinking, I've put money aside, I'm going to invest it in my TFSA for 2 years, you know, investing in something speculative might not be the best idea if you know that you're going to need that money in 2 years. Okay, because you don't want to be taking money out of your portfolio necessarily when the market is way down or when your particular investment's way down. So consider your time horizon. If on the other side, you have some money that you want to invest and you don't intend to touch that money for many years, you know, I might consider, you might feel a little bit more safer going into this new industry or investing in companies that are sort of up and coming, maybe perceived to be a little bit more speculative. As always, remember the tax implications. So a company that is relatively new or a fund that's investing in companies that are relatively new are probably less likely to pay a dividend or a distribution. Remember, dividends and distributions are taxable. So if you are instead investing in maybe more established companies that you deem to be socially responsible, they may, now not necessarily, but may be more likely to pay some sort of distribution or dividend. That is taxable. So make sure then that you're holding these types of investments in the right types of accounts to reduce your tax exposure, okay? And finally, remember that this idea of socially responsible investing is really not a one-size-fits-all. So what I value to be socially responsible might be different than what you view to be socially responsible. So those would be things that I would consider for you to think about when you're trying to integrate this into your portfolio. As well, remember, just because we want to start maybe integrating socially responsible investments into our portfolio, don't completely ignore the other reasons why you were investing or some of your other values. So for example, if you are someone who's investing and is relying on dividends or distributions from your existing investments to fund your, you know, lifestyle or day-to-day living, you know, don't necessarily then completely remove all those types of investments from your portfolio, right? Like if you're going to need the cash flow from those other types of investments, I'm not necessarily going to recommend you go ahead and sell all those, right? Because you need those dividends or distributions for your living expenses or you're relying on them. So, you know, at this point, you might be thinking, okay, I'm ready to go. I'm going to invest in this fund and, you know, my RSP. Do I just put all my money into a socially responsible investment? How do I go about actually doing this? So one strategy we like to use a lot on the team is this whole idea of a core and explore. So if you have an existing portfolio or you're building out a portfolio, I'm not going to necessarily recommend that, oh, you should go only buy wind turbine companies, okay? Rather, take your portfolio, maybe carve out a portion, let's say 5 or 10%, and invest it in a cause that you feel strongly about. So you can still do that within whatever account the money in the investment is in. You're just carving out a piece from the core part of the portfolio and investing into something else that you feel really passionate about. Again, this could be a wind turbine company, or this could be a company that's advocating strongly for human rights. Really anything that you deem to be socially responsible. Now, if you have a portfolio already, please don't worry and think, oh my goodness, I've never considered anything about socially responsible investing. What am I invested in? Is it all bad companies? Probably not. For those of you who are invested with us, through funds, ETFs, or specifically with our Evolution privately managed accounts, a lot of these fund managers have already started taking an ESG approach to their investing. So yes, they're still going to try to put, stocks and investments into our portfolios that do have strong financial performance, but they also are layering on this ESG screen, right? To make sure that they are investing in good companies, or they're weighing what are the financial benefits versus how ESG is this company. Okay, so we can dive down with you as an individual investor more about this after the presentation, but a lot of fund managers, especially the ones we work with at Asante, are already incorporating these types of tools into portfolios. Okay, and finally, remember to diversify. I said earlier, don't maybe necessarily go and invest all your money into one type of company, but I really do urge you to diversify. And one of the ways you can do that is using this core and explore approach. So you have your core portfolio and maybe diversifying a little bit out into some of these other types of companies, in the accounts that you already hold. So far we've looked at, what is socially responsible investing. I think we have a much better idea now of what it is. It's really this umbrella term, this aspirational term that speaks to, I want to buy companies that pass a certain screen. We know that there's different ways we can measure SRI, because also sometimes just putting a screen on and saying I'm going to include or I'm going to exclude certain types of companies, we might be missing out on companies doing that. So that's why we bring up this idea of environmental, social governance integration. So we start looking at investments under a different lens and really sort of peeling back those layers a little bit. These types of investments are gaining more in popularity. Again, I think COVID had a lot to do with this, and a lot of things we saw in the news last year is that investors are demanding more for their companies, and they want to know, how do you treat your employees and how are you treating the people that you work with? Okay, as well, the types of investors that are coming more into the market, millennials and female investors, have traditionally been more inclined to invest in investments that are good for the environment, are good for their families, and are good for mankind. Okay, again, yes, so it's millennial and female investors, but I think that sort of investing populations as a whole, more people are starting to see these investments. And part of the reason more people are interested is simply because there are more options available and we're not as limited as to what type of socially responsible investments we can buy. Okay, we also learned that we can buy socially responsible investments in our existing portfolios. And you can do that by either investing in individual stocks, so companies that you support, or through funds or mutual funds, ETFs or mutual funds. So that concludes the formal part of our presentation today. And if anyone has any questions, please feel free to email myself, Steve, Ramey, or Norma on the team. And we will be making this presentation available on our YouTube channel in the coming days. So that if there's any part of it that you want to go back and watch later, you can certainly do that. Okay. Thank you everyone for joining today, and enjoy your long weekend. Bye now.